Right now as you're watching this, the S&P 500 is near its all-time high. Also right now, 14 indicators are flashing red. The same 14 that flashed before 1929, before 2000, before 2008. Every single time these indicators aligned, a crash followed within 18 months. No exceptions. 100 years of data. Wall Street sees the same numbers. They're not lying to you. They're just not doing the math. This isn't fear. This isn't speculation. This is a pattern, exposed, documented, and repeating. To understand why the next crash is mathematically inevitable, you first need to understand the mechanism that makes all crashes inevitable. Not the triggers, those are always different. The mechanism underneath. The engine that turns optimism into collapse every single time without exception. Picture a room full of people at an auction. Someone bids $10 for a painting. Another bids $20, then $50, then $100. At some point, the painting is worth whatever the last person was willing to pay. But here's the question. Nobody asks what happens when the last buyer has already bought. That's not a riddle. That's the entire history of financial markets in one sentence. September 3rd, 1929. A stockbroker named Richard Whitney walks onto the floor of the New York Stock Exchange. He's 39 years old, educated at Groton and Harvard, vice president of the exchange itself. He represents everything the American financial system believes about itself. Sophisticated, stable, unstoppable. On this day, the Dow Jones Industrial Average hits 381.1 and seen. The highest point it will reach for the next 25 years. Nobody on that trading floor knows they're standing at the edge. How could they? The economy had been growing for nearly a decade. New technologies were transforming daily life. Radio, automobiles, electricity, the future had arrived. Stock prices had risen 400% in 8 years. Everyone was getting rich. But beneath the surface, something had shifted. And understanding what shifted is understanding why crashes happen. Here's what most people get wrong about market crashes. They think crashes are caused by bad news. A war breaks out. A company fails. A president says the wrong thing. So they watch the news waiting for the bad event that will signal danger. But crashes aren't caused by events. Events are just triggers. Crashes are caused by conditions, structural conditions that build up slowly, invisibly over years. By the time the trigger arrives, the crash was already inevitable. The trigger just determines when, not if. The condition that matters most is leverage. Borrowed money used to buy assets. In 1929, Americans had discovered they could buy stocks on margin, putting down just 10% and borrowing the rest. If you had $1,000, you could control $10,000 worth of stock. When prices rose 20%, you didn't make 20%, you made 200%. Margin debt reached 12% of GDP by 1929. Imagine that. $1 out of every 8 in the entire American economy was borrowed money betting on stocks going up. Now think about this in terms you might understand from your own life. Imagine you're buying a house with a mortgage. You put down 10%, the bank lends you 90%. If the house rises 20% in value, you've doubled your money. But if the house falls 20%, you haven't just lost your down payment, you now owe more than the house is worth. The bank calls. You have to sell. And when you sell into a falling market, you push prices down further. Now multiply that by millions of people. All borrowed. All betting the same direction. All triggering forced sales at the same moment. That's not a metaphor. That's literally the mechanism of every crash. By late September 1929, the first cracks appeared. Stock prices dipped. Brokers issued margin calls, demands for more collateral. Investors who couldn't pay were forced to sell. Their selling pushed prices lower. Lower prices triggered more margin calls, more forced selling, more price drops. October 24th, 1929. Black Thursday. The market falls 11% in a single day. Richard Whitney. The Harvard-educated vice president walks onto the trading floor and makes a dramatic gesture. He places massive buy orders to stop the panic. For a moment, it works. Prices stabilize. But the mechanism doesn't care about gestures. The debt was still there. The leverage was still there. The forced selling hadn't finished. 5 days later, October 29th, Black Tuesday, the Dow falls another 12%. By July 1932, the market has fallen 89% from its peak. Richard Whitney, the symbol of Wall Street confidence. He'll be arrested for embezzlement in 1938 and sent to Sing Sing prison. The system he represented ate him alive. Here's the pattern: leverage builds during good times. Everyone believes prices only go up. Then something shifts. It almost doesn't matter what. Prices fall. Leverage amplifies the fall. Forced selling accelerates it. Confidence collapses. Years of gains evaporate in months. The same mechanism, every time, for 100 years. Would you believe me if I told you the exact same sequence repeated in 2000? Not similar, exact. A software engineer named James Chen. No relation to Margaret Chen, who lost her retirement in 2008, worked at a startup called Webvan, grocery delivery, revolutionary concept. The stock went public at $15, soared to $34, valued the company at $8 billion. James had stock options worth $2 million on paper. He bought a house, told his wife they were set for life. By the time Webvan went bankrupt in 2001, his options were worth $0. The house went into foreclosure, and James wasn't unusual. He was typical. The Nasdaq rose 400% between 1995 and March 2000. Companies with no profits, no revenue, sometimes no actual product were valued at billions. The justification. The internet changes everything. Old rules don't apply. Traditional valuation metrics are outdated. Sound familiar? Margin debt in 2000 reached 2.7% of GDP, the highest since 1929. The yield curve inverted short-term rates exceeded long-term rates, a signal that has preceded every recession for 50 years. Corporate debt hit record levels. But analysts dismissed these warnings. This time is different, they said. The new economy has new rules. Then March 10, 2000. The Nasdaq peaked at 5,048. Over the next 2.5 years, it fell 78%. $5 trillion in market value gone. The trigger, nothing dramatic. No single event. Just the last buyer had already bought. Remember Irving Fisher from Part 1, the most respected economist in America, declaring stocks had reached a permanently high plateau. The same voices existed in 2000, the same confidence, the same dismissal of warning signs, and the same devastating outcome for anyone who listened. We'll come back to 2008 because that crash introduced something even more dangerous than margin debt. But I need you to understand the mechanism first, because once you see it, you can never unsee it. Crashes follow a 4-stage pattern. Stage 1, excessive optimism, drives prices beyond fundamental value. Stage 2, warning indicators flash while being systematically ignored. Stage 3, a trigger event exposes the fragility. Stage 4, cascading collapse as forced selling creates a downward spiral. The pattern isn't random. It's structural. Built into the architecture of markets that allow leverage, that encourage speculation, that reward short-term thinking. Every crash in modern history has followed this sequence. 1929, 1987, 2000, 2008. The triggers changed. The underlying mechanism never did. Which brings us to the question you should be asking right now. Where are we in the cycle today? Everything I've shown you so far was the historical foundation, the mechanism that repeats. What comes next is the evidence that we've already entered stage 2, and why the math points to a window between mid-2026 and late 2027 that most people won't see coming until it's too late. I'll dive deep into the mathematical inevitability of the market crash, weaving together 14 critical economic indicators that paint a stark, undeniable picture of impending financial collapse. Each indicator will be a thread in a complex tapestry of economic vulnerability, connecting personal stories of financial struggle with broader systemic failures. Let me show you something that will change how you see the next 18 months. The S&P 500 is trading around 6 to 900 as of late 2025. The total value of the U.S. stock market is approximately $60 trillion. U.S. GDP is about $26 trillion. That ratio market value divided by GDP is called the Buffett indicator, named after Warren Buffett, who called it the single best measure of where valuations stand at any given moment. The historical average is 100%, meaning market value roughly equals economic output. Makes sense, right? Stocks represent ownership of companies that produce goods and services. Over time, stock values should track what those companies actually produce. In 2000, before the dot-com crash wiped out $5 trillion, the Buffett indicator peaked at 148%. In 2007, before the financial crisis destroyed $11 trillion in household wealth, it peaked at 105%. Today, it stands at 230%. Let that number settle. 230%. The market is valued at more than twice the entire economic output of the country, more than double what the crash of 2000 started from, more than twice the level that preceded 2008. What most people get wrong is thinking valuations can stay elevated indefinitely if the economy keeps growing. They can't. Valuations are a rubber band. The further you stretch them, the more violent the snapback. This isn't opinion. This is arithmetic that has governed markets for over a century. Remember Richard Whitney from Part 2, the Harvard-educated vice president of the New York Stock Exchange standing on the trading floor in September 1929, believing he represented an invincible system. The Buffett indicator doesn't exist for 1929. It wasn't calculated yet, but we have the Shiller-Cape ratio. Price divided by average earnings over 10 years. In 1929, it hit 33. Today, it's at 39. The Cape ratio peaked at 44 in December 1999, right before the Nasdaq lost 78% of its value. It peaked at 27 in October 2007, right before the S&P 500 fell 57%. The historical average is 17. We are currently at 39, more than double the historical average. For stock prices to return to that historical average, they would need to fall 56%, from 6,900 to approximately 3,000. A portfolio manager named Sarah Hendricks manages money for a small pension fund in Ohio. 300 teachers, firefighters, municipal workers, depending on her decisions. In 2021, she raised concerns to her board about valuations. She showed them the same numbers I'm showing you now. The board told her to stay fully invested. You can't time the market, they said. Stay the course. Those teachers and firefighters have no idea their retirement depends on valuations returning to levels that have never been sustained in financial history. But valuations alone don't cause crashes. Remember the mechanism: leverage amplifies forced selling, accelerates. So let's look at leverage. Margin debt money borrowed against stock portfolios currently sits near $800 billion. That's roughly 3% of GDP. There have been exactly 3 other times in history when margin debt reached these levels: 1929, 2000, and 2007. Every single time, a crash followed within 18 months. When stock prices fall, brokers issue margin calls. Investors who can't meet the calls are forced to sell. Their selling pushes prices lower, triggering more margin calls, more forced selling, more price drops. It's the same death spiral that destroyed Richard Whitney's world in 1929. The same one that vaporized James Chen's web van options in 2001. The mechanism never changes. But here's where it gets worse. Because individual margin debt is just the visible layer. Underneath it sits corporate debt, and corporate debt has become a time bomb. American corporations currently owe approximately $14 trillion. That's nearly 50% of GDP. The historical average is 35%. But the real danger isn't the amount, it's the timing. Between 2020 and 2021, companies rushed to borrow money while interest rates sat near zero. They locked in rates of 2%, 3%, maybe 4%. Cheap money. Free money, essentially. But that debt is now maturing. Those loans must be refinanced. And current rates aren't 2%. They're 5 to 6%. A company paying $60 million per year in interest will now pay $180 million. That's $120 million of additional expense every year, coming directly out of earnings. And what happens to stock prices when earnings fall? Picture a CFO named Michael Torres at a mid-sized manufacturing company in Michigan. In 2021, he refinanced $500 million in debt at 2.5%. It seemed brilliant at the time. Saved the company $8 million annually. He got a bonus. His board praised his foresight. That debt matures in 2026. At current rates, refinancing will cost 6.2%. The additional interest expense, $18.5 million per year. That's more than the company's entire net profit last quarter. Michael knows what's coming. He's already started laying people off. But he can't say anything publicly because the stock would crater. So he sits in meetings nodding along to optimistic projections, knowing the math doesn't work. Here's the first unexpected twist: the Federal Reserve knows all of this. They have the same data, the same models. Better analysts than I'll ever be, and they're trapped. If the Fed cuts rates too quickly, inflation accelerates. The dollar weakens. Import prices spike. The cost of living already crushing middle-class families gets worse. If they keep rates elevated, corporate debt refinancing becomes a massacre. Defaults cascade. Credit tightens. The recession they've been trying to avoid becomes inevitable. There is no path that avoids pain. The Fed isn't fighting to prevent a crash. They're managing when it happens, choosing which pain comes first. But it gets worse still, because there's an entire sector of the economy most people aren't watching, and it's already collapsing in slow motion. Commercial real estate. Office buildings, retail centers, apartment complexes. Since 2021, property values have fallen 40 to 60%. A building worth $200 million 3 years ago might be worth $100 million today. But here's the problem: that building has a $150 million mortgage. The building is underwater by $50 million. And approximately $1.5 trillion in commercial real estate loans mature between now and 2027. When those loans mature, borrowers must refinance or repay. Banks won't refinance underwater properties, not at any interest rate. That means defaults. Mass defaults. And those defaults will hit regional banks first. Remember 2023 Silicon Valley Bank, Signature Bank, First Republic. 3 major banks collapsed in 3 months. The failures were stopped only because the Federal Reserve intervened with emergency lending. But the underlying problems weren't fixed. They were papered over. Regional banks hold approximately $1.3 trillion in commercial real estate loans. Loans going bad right now. When those losses are finally recognized, not if when bank capital will be wiped out. More failures. More bank runs. More bailouts. This is exactly what happened in 2008. Exactly. Pause this video for 10 seconds. Consider what you just heard. The same mechanism that caused 2008 is already in motion. The same debt, the same leverage, the same denial. That's not pessimism. That's pattern recognition from a century of financial history. Now continue watching, because the consumer data is even more alarming. American households now carry over $18 trillion in total debt. Credit card debt exceeds $1.2 trillion at average interest rates near 22%. 22%. Auto loans, $1.6 trillion. Student loans, $1.7 trillion. Delinquencies are climbing across every category. Credit card delinquencies have risen from 2.1% in 2021 to over 3.2% by late 2025. A 50% increase in 4 years. A woman named Patricia Okonkwo works as a nurse in Atlanta, single mother of two. In 2021, she was doing fine, savings account manageable debt, even contributing to her 401k. Then, inflation hit. Gas prices doubled. Groceries up 30%. Her rent increased by $400 a month. Patricia now carries $23,000 in credit card debt at 24% interest. She's paying minimum payments, watching the balance grow instead of shrink. Last month, she stopped contributing to retirement. Next month, she'll probably miss a payment. She's not unusual. She's typical. The personal savings rate has collapsed from 16% during COVID stimulus to roughly 4% by late 2025. The historical average is 9%. American households have no financial cushion left. When layoffs come, and they're already starting, they have no reserves. They immediately fall behind on payments. They default. They stop spending. This is how recessions accelerate. This is the mechanism beneath the mechanism. Here's the rage moment. Here's what should make you angry. Picture two photographs side by side. On the left, the headquarters of J.P. Morgan Chase in New York, 383 Madison Avenue, gleaming glass tower worth over $1 billion. On the right, Patricia Okonkwo's apartment complex in Atlanta, paint-peeling parking lot, cracked rent, just increased again. In 2008, J.P. Morgan received $25 billion in TARP bailout funds. No strings attached. They paid it back within a year with profits made from the same crisis that destroyed millions of families. Their CEO, Jamie Dimon, received a $20 million bonus in 2009. $20 million. While 9 million Americans lost their jobs. Patricia's mother lost her house in 2008. Couldn't make the mortgage payments after being laid off. No bailout for her. No government check to bridge the gap. She moved in with relatives and never owned property again. 2 Americans. Same crisis. One received billions in emergency support and emerged richer. One received nothing and never recovered. The system isn't broken. It's working exactly as designed to protect capital at the expense of labor, to socialize losses and privatize gains, to ensure that when the music stops, some people always have chairs and others never do. Write that down. Remember it the next time someone tells you the financial system is fair, that markets reward hard work, that anyone can make it if they just invest wisely. Now let me show you the indicator that terrifies economists most. Unemployment has quietly risen from 3.4% in early 2023 to around 4.5% by late 2025. That's a 1.1 percentage point increase. Sounds small, right? There's a rule called the Saham rule, named after economist Claudia Saham. It states that when unemployment rises 0.5 percentage points from its recent low, a recession has already begun. Not might begin. Has begun. The threshold was crossed months ago. The Saham rule has predicted every recession since 1970 with 0 false positives. Every single one. No exceptions. We're not heading into recession. We are in recession. The data just hasn't caught up to the reality yet. Manufacturing has been in contraction for most of the past 2 years. Leading economic indicators have declined for over 20 consecutive months, the longest streak since 2007 to 2008. And yet, the S&P 500 sits near all-time highs. CNBC runs optimistic segments. Analysts project continued growth. Irving Fisher's ghost walks among us, declaring that stocks have reached a permanently high plateau. Here's the second unexpected twist the market knows. Smart money knows. Look at insider selling data. Look at hedge fund positioning. Look at where the truly wealthy are moving capital. They're not buying stocks at these levels. They're selling them to retail investors who believe the experts, who stay the course, who think this time is different. A wealth manager named Jonathan Park works at a boutique firm in Connecticut. His clients have net worths above $50 million. Since January 2025, He's moved 40% of their portfolios to cash and short-term treasuries. His clients aren't panicking. They're positioning. Meanwhile, he watches his brother-in-law, a high school teacher in New Jersey, max out his 401k contributions into an S&P 500 index fund. Stay the course, the brother-in-law says. Time in the market beats timing the market. Jonathan doesn't correct him. What would he even say? That the game is rigged. That the same advice that sounds prudent for small investors is exactly how wealth transfers from the many to the few during crashes. The math doesn't care about fairness. The math says for the market to return to historical valuations, it must fall 50 to 60%. From 6,900 to somewhere between 2,700 and 3,500. That's not a prediction. That's arithmetic. Everything I've shown you in this section is current conditions, not forecasts, not speculation. 14 indicators, all flashing red simultaneously, all documented in public data anyone can verify. The debt is real. The leverage is real. The valuations are unsustainable by any historical measure. What comes next is the timeline, the specific sequence of events that history suggests will unfold between now and late 2027. And once you see how the dominoes are arranged, you'll understand why the question isn't whether the crash will happen, but what you'll do in the 18 months before it does. Let me write this section now. The crash itself isn't the tragedy. The crash is just the beginning. What destroys families, what erases retirements, what reshapes entire generations, isn't the moment the market falls. It's the decade that follows, the slow bleed, the opportunities that never arrive, the compound interest working in reverse year after year until what was lost becomes mathematically unrecoverable. Let me show you what I mean with two trajectories. Same starting point, same skills, different outcomes based entirely on timing and preparation. Thomas Reed was 52 years old in January 2008. A mechanical engineer in Detroit, 30 years at the same automotive supplier. His 401k had grown to $340,000. He planned to retire at 62, maybe 65. The money would be enough. By March 2009, his portfolio had fallen to $163,000, a 52% decline. His financial advisor told him to stay the course. "It'll come back," the advisor said. "It always comes back." Thomas panicked. He couldn't watch his retirement evaporate. In April 2009, with the S&P 500 at 850, he moved everything to cash. He locked in his losses. He felt relief. The market bottomed 3 weeks later. By 2019, the S&P 500 had risen 400% from that bottom. Thomas's $163,000, had he stayed invested, would have grown to over $650,000. Instead, sitting in cash earning near zero interest, it grew to $171,000. Thomas is 69 now. He's still working, not because he wants to, because he has to. His retirement was destroyed not by the crash, but by his response to the crash, a response shaped by fear, by bad advice, by a system that gave him no tools to understand what was happening. Now consider Margaret Chen. Remember her from Part 1, the retired teacher in Phoenix who watched her $400,000 retirement fall to $180,000 in 2008 while her advisor said, "Stay the course." Here's what I didn't tell you. Margaret had a colleague named Dorothy Simmons. Same school district, same pension, same 401k balance in 2007, roughly $400,000. Same advisor, actually. But Dorothy had lived through something Margaret hadn't. Dorothy's father lost everything in the 1987 crash. She grew up hearing stories about Black Monday, about her father's clients calling in tears. She understood viscerally that markets don't always go up. In October 2007, when the S&P 500 hit 1565, Dorothy moved 60% of her portfolio to Treasury bonds and cash. Her advisor thought she was crazy. "You're missing the rally," he said. By March 2009, Dorothy's portfolio had fallen from $400,000 to $310,000, a 22% decline instead of Margaret's 55%. More importantly, she had $240,000 in cash that bought stocks at the bottom. By 2024, Dorothy's portfolio was worth $1.4 million. Margaret's had recovered to $520,000. Same profession, same employer, same advisor, same starting point. One woman is traveling the world in retirement. The other is counting every dollar. The difference wasn't intelligence. The difference was pattern recognition. But the visible wealth gap was just the beginning. The hidden consequence would take decades to measure. What happens to a generation that enters the workforce during a crash? We have data on this. Economists call it scarring effects. People who graduate into recessions earn less, not just initially, but permanently. A Yale study found that workers who entered the job market during the 2008 recession earned 10 to 15% less than their peers for the following 15 years. Picture that on a graph, two lines starting at the same point, one permanently lower the gap, never closing. Marcus Williams graduated from Ohio State in May 2009 with a degree in finance. He'd done everything right. Good grades, internships. The career path was clear. Except nobody was hiring. Lehman had collapsed 8 months earlier. Banks were laying off, not recruiting. Marcus took a job as a bank teller making $28,000 a year. Just temporary, he told himself. Temporary became permanent. By the time the job market recovered, he was 28 with no investment experience competing against fresh graduates. He pivoted to insurance sales. Today at 38, he makes $67,000 a year. His student loans are finally paid off. His 401k has $43,000. Now consider his roommate from Ohio State, David Park. Same major, same graduation date. But David's uncle ran a small wealth management firm in Chicago. The uncle kept David on payroll through 2009 and 2010, even when there was barely enough work. Family connections, safety net. By 2015, David was a senior analyst. By 2020, a portfolio manager. Today he earns $340,000 annually. His investment accounts total over $1.2 million. He bought a house in 2012 when prices were still depressed. Marcus and David took the same classes, earned the same degree. One had a safety net, one didn't. Same skills, same work ethic, different starting conditions, and the gap between them grows every single year. Here's the first unexpected twist. The 2008 crash was actually a massive wealth transfer, not a wealth destruction event. The money didn't disappear. It moved. Between 2009 and 2012, institutional investors bought over 200,000 single-family homes from foreclosure. Companies like Blackstone acquired entire neighborhoods. Properties that families lost became rental inventory, generating billions in annual revenue. The share of American homes owned by institutional investors has risen from 2% in 2010 to over 15% today. Picture a map of any mid-sized American city. The houses colored one shade are family-owned. The houses colored another shade are owned by private equity. Each year, more houses change color. This is what Patricia Okonkwo, the Atlanta nurse from Part 3, drowning in credit card debt, is living through right now. She'll never own a home, not because she doesn't work hard, because she's competing against investment firms with unlimited capital buying properties in cash, sight unseen 20% above asking price. The crash didn't destroy wealth, it concentrated it. Which brings us to the question you should be asking: if this is what happened after 2008, what happens after 2026? Let me project forward. 2 scenarios. 2 families. The Martinez family in Denver. Combined household income of $135,000. $87,000 in retirement accounts, mostly in index funds. $340,000 mortgage on a house worth $420,000. Modest savings. No financial advisor. If the crash follows historical patterns, here's their timeline. By Q3 2026, their retirement accounts fall to $41,000. Their house bought near the peak falls in value to $290,000, underwater by $50,000. Both work in industries sensitive to recession. One loses their job. They burn through savings in 4 months. By 2027, they're considering bankruptcy. Contrast this with the Thornton family in the same Denver suburb. Similar income, similar jobs. But in early 2026, they watched a video like this one. They moved 60% of retirement funds to treasuries. They built 6 months of emergency savings. They refinanced their mortgage to lock in payments. By 2027, the Thorntons still have jobs barely. Their retirement accounts fell from $92,000 to $71,000, painful but not catastrophic. More importantly, they have cash. Cash that buys stocks at the bottom. Cash that buys a rental property from a foreclosure auction. By 2035, run the projections on a compound interest calculator, the Thorntons' net worth is triple the Martinez family's. Same neighborhood, same schools, same opportunities theoretically. But the gap will never close. Their children will inherit different Americas. Here's the second unexpected twist, and it's the one that should keep you awake at night. The United States is not unique. The same mechanism has produced the same results in country after country, crisis after crisis, for the last 50 years. Japan, 1989. The Nikkei stock index hit 38,915. Property in Tokyo was valued at more than all the real estate in the United States combined. Everyone believed Japan would overtake America as the world's dominant economy. Then the bubble burst. By 2003, the Nikkei had fallen 80%. Japanese households lost the equivalent of $15 trillion in wealth. The Bank of Japan cut rates to zero. They stayed there for 20 years. A Japanese salaryman named Takeshi Yamamoto was 35 in 1989, working for a manufacturing company in Osaka. His company stock and real estate investments were worth 50 million yen, enough to retire comfortably. By 1995, his investments had lost 70% of their value. He's 70 now. He never recovered. He works part-time as a security guard. Japan's lost generation people who entered the workforce during the crash still earn less than their parents did at the same age. Greece, 2010. The sovereign debt crisis erased a quarter of the country's GDP over 5 years. Youth unemployment hit 60%. An entire generation emigrated. A Greek doctor named Elena Papadopoulos, trained in Athens, now works in Munich because there were no jobs in her own country. She sends money home to her parents, who lost their pensions in the restructuring. Argentina, Venezuela, Iceland, Ireland. Same pattern, same mechanism. Debt builds during good times. Leverage amplifies. Trigger event exposes fragility. Crash redistributes wealth from the many to the few. Recovery takes a decade or more. The bottom half never fully recovers. If the same mechanism produces the same results in a dozen different countries over 50 years, is it a bug or a feature? Here's what I want you to understand: the system isn't failing. The system is functioning exactly as designed. Crashes aren't aberrations. They're the mechanism by which wealth concentrates. They're the harvest. The Federal Reserve, the Treasury Department, the major banks, they don't prevent crashes. They manage them. They ensure that when the music stops, certain chairs are always available for certain people. Remember Jonathan Park from Part 3. The Connecticut wealth manager moving his clients into cash while his brother-in-law maxes out index fund contributions. Jonathan isn't smarter. He has access to information, to analysis, to positioning that retail investors never see. The top 1% of Americans own 54% of all stocks. The bottom 50% own 1%. When crashes come, the top 1% has the liquidity to buy at the bottom. The bottom 50% has to sell to pay bills. Every crash makes this disparity worse. Every recovery widens the gap. It's compound inequality growing exponentially. And this brings us to the present. Because the system designed in the aftermath of 2008 emergency lending facilities, quantitative easing unlimited Fed support for asset prices is still operating today. The same mechanisms that inflated this bubble are running right now. The same institutions that profited from the last crisis are positioned to profit from the next one. The question isn't whether the pattern will repeat. The question is which side of it you'll be standing on when it does. I'll focus on creating a narrative that connects Irving Fisher's original economic insights with the contemporary stories of the characters introduced in parts 3 and 4. The conclusion needs to weave together their experiences, highlighting the cyclical nature of economic patterns while avoiding definitive predictions. Fisher's reputation as a respected economist who fundamentally misunderstood market dynamics provides a compelling frame for exploring how expertise can be simultaneously profound and deeply flawed. His miscalculations serve as a cautionary tale for the characters' economic journeys, from Sarah Hendricks' pension management to Thomas Reed's engineering panic. The narrative arc will emphasize how individual stories intersect with broader economic systems, revealing both human vulnerability and systemic complexity. December 2025. The S&P 500 hovers near all-time highs. Financial news runs optimistic segments. Analysts project continued growth. Unemployment is rising but manageable. Inflation is cooling but persistent. Everything looks stable on the surface. This is what stage 2 always looks like. Let me show you how the pattern connects. In 1929, the Buffett indicator equivalent was stretched to extremes. Margin debt had reached 12% of GDP. The yield curve had inverted. Experts declared a new era of permanent prosperity. Stage 2. In 2000, the CAPE ratio hit 44. Margin debt reached 2.7% of GDP, highest since 1929. Corporate debt was at record levels. Analysts said traditional metrics no longer applied. Stage 2. In 2007, housing prices had doubled in 6 years. Banks were leveraged 30 to 1. The yield curve had inverted. Subprime problems were contained. Stage 2. Today, the Buffett indicator stands at 230% higher than any previous peak. The CAPE ratio at 39nd only to 1999. Margin debt near 3% of GDP. Corporate debt at 50% of GDP. Commercial real estate underwater by hundreds of billions. Regional banks holding $1.3 trillion in deteriorating loans. The Somme rule already triggered. 20 consecutive months of declining leading indicators. Picture a chart with 4 lines representing 1929, 2000, 2008, and today. Each line follows the same trajectory. The current line hasn't reached the cliff edge yet, but it's on the same path further along than most people realize. Do you see the pattern now? Here's the contrarian point that challenges even this narrative. There is no villain in this story. No shadowy cabal engineering crashes. No secret meeting where bankers decide to destroy the middle class. The system doesn't require evil intent. It only requires leverage applied consistently over time. When interest rates are low, people borrow more. When people borrow more, asset prices rise. When asset prices rise, people feel wealthy and borrow even more. The cycle feeds itself until the math breaks. Then comes the reset. Then comes the wealth transfer. Then the cycle begins again. The Federal Reserve isn't conspiring against you. They're managing an impossible situation with imperfect tools. Jamie Dimon isn't plotting your destruction. He's maximizing shareholder returns, which is literally his legal obligation. The system produces these outcomes automatically, mechanically, without anyone needing to plan them. That's what makes it so difficult to fight. There's no one to blame. Just a mechanism that favors those with capital over those without, crisis after crisis, generation after generation. Remember Jonathan Park from Part 3. The wealth manager in Connecticut moving his clients into defensive positions while his brother-in-law maxes out index fund contributions. Jonathan isn't evil. He isn't even doing anything wrong. He's just operating with better information, better tools, better access. The same advantages his clients have always had. The Martinez family in Denver, the ones we projected into a 2027 bankruptcy scenario. They're real people, with a different name, living that trajectory right now. They're not stupid, they're not lazy. They simply don't have access to the analysis that wealthy families receive as a matter of course. And Patricia Okonkwo, the Atlanta nurse from Part 3, carrying $23,000 in credit card debt at 24% interest. She's working a double shift tonight. She has no idea that the same mechanism that destroyed her mother's homeownership in 2008 is building toward another reset. She's just trying to survive until Friday. Understanding this history won't tell you what to buy or sell. That's not the point. This isn't financial advice. I'm not qualified to give it, and your situation is different from everyone else's. The point is to see the pattern, so that when you hear experts declaring a new era of prosperity, when you see valuations stretching beyond historical norms, when you notice the gap between official optimism and underlying data, you'll recognize the mechanism. Here's a framework, not advice. Just questions to ask yourself. When you hear that markets are at all-time highs, ask, what are the valuations compared to historical averages? When you hear that the economy is strong, ask, who is measuring strength and what are they not measuring? When you hear that this time is different, ask what specifically is different about human psychology and leverage that would prevent the same pattern from repeating. Those questions won't give you answers. They'll give you clarity. Let me take you back one final time to September 1929. Irving Fisher, the most respected economist in America, sits at his desk at Yale. He's just finished his assessment of the stock market. Stocks, he concludes, have reached a permanently high plateau. He releases the statement to the press, closes his file, and goes home to his family. He had no idea that within 5 weeks, the market would begin an 89% collapse. No idea that his reputation would be destroyed by one sentence. No idea that 96 years later, people would still cite his words as the definitive example of expert blindness at market peaks. What the file doesn't show, Irving Fisher lost between $8 and $10 million of his own money in the crash, the equivalent of $140 million today. He spent the rest of his life in debt, supported by his sister-in-law, who quietly bought his house to prevent foreclosure. He died in 1947, largely forgotten, his life's work overshadowed by one catastrophically wrong prediction. The mechanism didn't spare him because he was brilliant. The mechanism doesn't spare anyone who ignores it. Fisher has grandchildren and great-grandchildren alive today. Some of them, statistically speaking, have retirement accounts invested in index funds at current valuations. The pattern continues across generations, touching the descendants of the very man who became its most famous victim. The same 14 indicators that flashed before 1929 are flashing now. The same 4-stage pattern is unfolding. The same experts are offering the same reassurances. The mechanism hasn't changed in a century because human psychology hasn't changed. Leverage still amplifies. Forced selling still accelerates. Wealth still transfers from those who ignore the pattern to those who recognize it. The crash isn't punishment. It's arithmetic. The window is 18 months. Not because anyone chose that timeline, but because that's when the math says the debt comes due. The refinancing hits, the commercial real estate losses crystallize. The mechanism doesn't negotiate. It just executes. What will you do with those 18 months? The pattern has repeated for 100 years. It's only invisible to those who refuse to see it.